All right, here we are again. So let's see what we're doing tonight. All right, let's see. All right, this is the third week. And so we have, this week we're looking at interest rates and currency swaps. Now, this week we also have a template set up. Here we go. Because a lot of this work is very time consuming. So I've set up this Excel template, which I did send you a copy of it last week sometime, so that we don't have to waste all night setting up these spreadsheets. The calculations they're not that complicated, but it's good to have them organized properly so you can see what we're doing. So I've got slots here for an interest rate swap. We have a foreign exchange swap, and actually we have two of them. And in all three cases, our job is to figure out what the value of the swap is to the two counterparties. And there's usually a couple of different ways of going about this. So first, let's get to the notes. We'll see what this is all about. All right. Now, and by the way, if we run a little short here in time, let's see, week 4, just out of curiosity. Oh yeah, options. Okay. So we'll see how it goes. If we finish a little early, maybe we'll take a peek at these options. But right now, we're going to focus our attention on swaps. Now, we've already been introduced to swaps, but now we want to take a closer look at them because we want to not just understand how they're structured, but we also want to understand how they're priced in the marketplace. So swaps are over-the-counter products. So they don't trade in an organized exchange, but they do have a dollar value. And so because there's two counterparties to the transaction, whatever the value is to one side is the opposite of the other side. So in other words, if the buyer of the swap has a value of $1,000, that means the seller has a value of negative $1,000. So it's a zero-sum game, so to speak, with a swap because the gains of one side must equal the losses to the other side. So if you look at a Bloomberg terminal, and you can actually look up these swaps, and it will actually tell you what they're worth to the two counterparties. They do have a brief explanation as to how they came up with those numbers. And so I don't know if any of you have a Bloomberg at work, but they do actually carry swaps pricing, or at least you can subscribe to it. I don't know if every Bloomberg terminal has them. It depends on what you pay for, I suppose. But I know from experience that Bloomberg does carry a page where you can actually price out interest rate and currency swaps based on their terms and conditions. So what are we planning on doing in this chapter? First of all, we want to review the key features of interest rate and currency swaps. We want to understand how they're priced in the market, which is something we haven't done up to this point. Learn how the swaps are used for hedging purposes, which is, of course, the whole point of having swaps, and understand other types of swaps that trade in the market. All right, so we did mention at one point that besides interest rate and currency swaps, there are many other kinds of swaps out there. They're not nearly as popular, but they're still very powerful in spite of that. All right, so we'll start with interest rate swaps. And of course, we remember from a couple of weeks ago, this is a derivative security in which two counterparties exchange cash flows based on the difference between two rates of interest. There's always a notional principal underlying each swap. This is how we determine the actual dollar amount of the payments. Okay, so in other words, it doesn't help to know what the interest rates are if we don't have a notional principal. So let's say if we have to swap 1% with each other, that 1% is 1% of the notional principal. So that way we know the dollar amount as well as the percentage. Now, by the way, with these interest rate swaps, as you would imagine, since these are over-the-counter products, they can be totally customized to the needs of the counterparties. There's, in principle, several different ways we can structure an interest rate swap. It just so happens, though, that the most popular approach is to use what's called a fixed for floating rate swap, where one interest rate is fixed in advance, and that could be literally any number. And then the other side would be a floating rate swap, which frequently is tied to LIBOR. Although it doesn't have to be, It can actually be tied to any rate you could imagine. For example, it could be the federal funds rate. It could be the prime rate. As long as there's a short rate of interest out there that resets periodically, we can use it to underlie our swap. Now, the choice would depend on what kind of exposure you have in the market. Although most of the time we typically see LIBOR uses the floating rate, if there's some good reason to tie it to the Fed funds rate or the prime rate, then there's nothing to stop you as long as you can negotiate that with a counterparty. And so many types of floating rates are possible, but usually in the past, at least until it disappears, LIBOR has been the choice for most interest rate swaps. I think that's partially because it's such a very deep and liquid market and it gets a lot of attention in the media. Also, there are many different maturities available for LIBOR up to a year, whereas that isn't really true for the Fed funds rate. The Fed funds rate is an overnight borrowing rate. And so there is no such thing, for example, as a 1 month Fed funds rate or a 3 month or 6 month. You do have that with LIBOR. In principle, you can have any rate you want up to a year with the LIBOR market. And that is kind of a big deal. Okay. And not only that, but these rates update themselves every single day. And the transactions in this market are quite large. So these rates are up to date. And until it was discovered how easy it was to manipulate them by the crooked banks, it was by far the most useful and popular type of floating rate in the world, really, because so many different derivatives contracts are based on it, as well as other types of securities that contain a floating rate provision. Now, in principle, the LIBOR rate is supposed to be the rate at which the major London banks borrow short-term funds from each other. The way it usually worked, and they may have modified it since the scandal happened, but there were 16 London banks that were surveyed every day by the British Bankers Association, and they were asked, what rate are you charging for your deposits from 1 to 12 months? And the surveys would be filled out, and what they would do is they would rank them from the lowest to the highest, and they would discard the highest and the lowest. And among the 14 in the middle, they would find some kind of an average of the whole group. So it was never an actual market rate of interest. It was always some kind of an average. And I don't remember the exact details, but it was not a single rate at which you could actually borrow or lend. It was some kind of an average. But once the banks figured out how to manipulate it to their advantage, then it became impossible to take it seriously. And so, of course, as I mentioned before, it's going to be replaced within the next year by other different types of interest. Okay, but in the meantime, let's carry on as if LIBOR is still the way to go for these interest rate swaps. So the fixed rate in a fixed for floating rate swap is known as the swap rate. That's just a point of terminology. When you read the words swap rate, they're talking about the fixed rate in the swap. I guess the floating rate is just called the floating rate. So the swap rate, that's important because later on when we start looking at options, it turns out that you can actually buy an option on a swap, which is known as a swaption. And when you do, the strike rate, as it's called, is compared directly to the swap rate in the underlying interest rate swap to determine the value of that swaption. All right, so anyway, here's an example. We have a corporation with $100 million worth of debt that has a 5-year maturity. The coupon on an annual basis is LIBOR plus 2%. Now, of course, what risk are they being exposed to? Well, they worry that interest rates will go up in the future, which means they'd have to pay a larger interest rate to the investors. Well, now, of course, this raises the question, why did they issue a floating rate bond in the first place? Well, the answer is most likely they believed at the time that rates would head down in the future. And they figured, well, if we're right, we'll save some money. But now maybe they've changed their minds. and they've decided, you know what, maybe we shouldn't have done this. Maybe let's hedge away this risk by entering into an interest rate swap. So what we have to do then is, because we're committed to paying LIBOR, we have to get into a swap in which we receive LIBOR or some function of it to offset the payments that we're making to our own customers or our own lenders, actually. So that way, whatever's left over, the net effect of all this is to get rid of the floating rate exposure and replace it with a fixed rate, which might be higher than we would like, but at least it eliminates our interest rate risk. Okay, we certainly do not want to find ourselves paying a lot more interest, especially on $100 million worth of debt. So in that case, because this is an interest rate swap, one side will be known as the fixed rate payer, and the other side will be known as the fixed rate receiver. The floating rate payer, my fault. Floating rate payer. We always think in terms of the payer, not the receiver, the payer. So one side is the fixed rate payer, the other side is the floating rate payer. Now, the tricky part here is to figure out which side we should take. If we enter into a swap, what exactly are we trying to do? All right, well, let's think about this again. We are concerned that rates may rise in the future. Now, if they do, which will require us to pay more interest. Now, of course, there is always I'll put this in parentheses, there is always a chance that rates will fall, which will save us money, but we don't want to take any chances. So yes, I mean, it could go either way, but we're concerned about the possibility of rising rates. Let's say that we have some reason to think that rates are heading up. Suppose we read something written by the chairman of the Fed, Jerome Powell, and we're pretty certain now that he intends to raise rates in the near future. So what do? We have to worry about this 5-year bond. So in order to offset our risk, we want to enter into a swap in which we receive LIBOR or a function of LIBOR, which can then be used to pay our floating rate obligation to the lenders or the bondholders, let's say. Okay, so therefore, we will enter into a swap as the fixed rate payer and the floating rate receiver. Okay, anything else wouldn't make any sense. In other words, the way to get rid of our risk is to enter into a swap as the fixed rate payer and the floating rate receiver. And that's the only way this is going to work. If we do the opposite, we'll actually make ourselves worse off. So now the question is, what exactly can we arrange with the dealer? And the dealer is typically an investment bank who makes a market in swaps. And so this is a diagram of, let's say that we enter into a swap with a dealer in which we agree to pay 6% in exchange for LIBOR in each of the next 5 years. Okay, so these are annual payments because the bond that we sold is also an annual pay bond. If the bond had semi-annual coupons, we could have arranged the swap to make or receive payments every 6 months. We want the payments from the swap to exactly line up with our payments to the bond, because that way we can completely eliminate our risk. And so because this is an over-the-counter product, it should not be a problem. There's no reason why we can't line up the cash flows in the swap to exactly match up with the cash flows that we have to pay to this bond. So let's say we did agree to LIBOR against 6%. So we can trace the path of these cash flows by looking at LIBOR coming from the dealer, which we then use to offset the LIBOR portion of what we owe to the bondholders. So the net effect here is that we have to pay, let's see, we receive LIBOR, but we also pay LIBOR. So these basically cancel each other out. We're paying 2% over here, and we're paying 6% here. So the amount that we're actually paying to everybody is 8%. And since the notional is $100 million, that means we're guaranteed that every year our interest costs are locked in at $8 million, regardless of the level of LIBOR. And that's essentially what we wanted to do. We know that we may be overpaying for this a little, but we don't have to worry about it going even higher if LIBOR were to rise any further. So anyway, so what we've accomplished is to eliminate our floating or interest rate risk, I should say, so that no matter what rates do, we're going to be locked into a payment of $8 million altogether between the bondholders and the swap dealer. All right, now, how about this one? Now the bank, the dealer, I should say, what happens to the dealer now? The dealer has taken on our risk. If you notice, now the dealer is exposed to the risk that rates will go up because the dealer is paying us LIBOR. If that goes up, they'll end up owing us money. So the dealer doesn't want to be exposed to interest rate risk either. So what can they do about it? Now, remember, this is a dealer. They're constantly making arrangements with corporations and banks and other types of businesses to enter into swaps. That's why they're called a dealer. They buy and sell swaps depending on what the customer wants. Just like a foreign exchange dealer, they'll buy or sell any currency that they deal with. And so you just have to tell them what currency you want, if you want to buy it or sell it, and then they'll quote you a price. The same thing is happening here with any dealer. They have an inventory of swaps, or they can create one for you, and then they can take either side of a swap. So this happens all day long. So if every time they entered into a swap, they exposed themselves to more risk, they'd be in a pretty bad spot. So what they can do instead is they can line up these swaps to offset each other and eliminate their own risk. So let's say, for example, we know here that the dealer is paying LIBOR in exchange for 6%. If LIBOR goes up, they're going to lose money. If LIBOR goes down, they're going to save money. So why don't they do this? Why don't they go out and find another swap that they've already either entered into or else they can enter into now? And what they want to do is exactly reverse these arrows. In other words, they want to receive LIBOR and then they want to pay a fixed rate, but it has to be a rate such that they can make money. All right, so in this case, they're not going to want to pay somebody else 6.5% because then they're actually losing money from the swap that they're making with the corporation. So, but on the other hand, it's a dealer. You know, they should be in a position where they can take advantage, or let's just say borrow and lend at an advantageous rate. So if they choose, let's say, or they find a bank who has the opposite outlook of this corporation. The corporation, remember, is worried about rates going up. Suppose the swap dealer locates a bank that's worried about rates going down. That's different because now they're taking the opposite position as the corporation. So they agree to enter into a swap with the bank, and it's 5 years, of course, and now the bank is paying the dealer LIBOR and receiving 5.95%. Does that help? Does that work? Yes, and you can see why. Because here, Remember, the dealer's paying LIBOR to the corporation, and they're getting back 6%. The bank is paying the dealer LIBOR, and they're getting back 5.95%. Why is there a difference? Because this is a dealer, and they make their money from the spread between what they arrange for these swaps. So this difference is the profit or bid-ask spread that goes into the dealer's pocket. So you see what they've managed to do. They've eliminated all of their own risk, and they've managed to put 0.05% in their pocket. Now that doesn't sound like a lot of money, does it? This is equal to 0.0005, and when you multiply that by $100 million, and I'm assuming that the notional principles are the same, let's see how much money they made on this deal. $50,000. I'll take that for a few minutes of my time to arrange these transactions with the corporation and the bank. So I'll take it. Yes, if I'm the dealer, I'm happy with that, because I've locked in a profit, and I've also gotten rid of any risk that I had. So that's how the dealer protects himself and also makes money. If that spread wasn't available, there'd be no point in being in this market in the first place. All right, so yes, and so of course what you're seeing here, the spread between the 6% and the 5.95 is what we call the bid-ask spread, because what their dealer is basically saying is that we will pay 5.95% and receive 6% for LIBOR. This would be the bid. It actually isn't a price, it's a bid rate, I guess. This is ask. And the spread between the two is the source of their profits. Now, in practice, though, this is how they tend to quote their bid-ask spreads. Instead of having an absolute number, what they'll do is they'll say, listen, whatever the current, let's say, treasury note rate is, or treasury bill rate, we'll add X points to that to come up with our quotes. So here, for example, what you're seeing is that for a 2-year swap in which you may enter as the fixed or the floating rate payer, the dealer, oh, by the way, this TN stands for treasury note. And just as a quick reminder, let me just go back here and sneak this in here. Just a little refresher. In the treasury market, there are 3 categories of treasury securities, and their names depend on their maturity date. So if the maturity is from 1 month to 12 months, or 1 year, of course, we call that a treasury bill. Okay. If it goes from 2 years to 10 years, we call that a treasury note. And anything from 20 years to 30 years is a treasury bond. Just a quick reminder in case you've forgotten about this. So in this case, the examples that I'm showing you are for swaps that range anywhere from 2 to 5 years. So they're all tied to the treasury note yield on that particular day. So you might see something like this. Oh, one more thing. Here's another quick point I want to make here. You'll notice in this table the letters BP. This is something unique to Wall Street. You don't normally see this anywhere else. 1% is defined to be 100 basis points. 0.1% or 0.01 is defined as 10 basis points. And then finally, 0.01% is 0.0001 or 1 basis point. So that's what they're called on Wall Street, okay? It works for them. They decided to call them basis points. So when you see that something like that written down, then you know what they mean. All right, now, so here, for example, if you're interested in entering into a swap with the dealer in a fixed interest rate swap, the dealer will pay 2-year treasury note yield plus 20 basis points in exchange for LIBOR. But they will accept from you. So in other words, if you as the hedger want to receive floating or receive fixed rather, this is the column. If you want to receive floating, then you're going to pay the dealer for this 2-year fixed rate interest rate swap, 2-year treasury note yield plus 28 basis points. And you notice the spread between the two is 8 basis points. That's the bid-ask spread. So on that particular day, the treasury note rate is 2%. So the actual quote is 2.2% on the pay side, 2.28% on the receive side. So basically what they're saying is that you take the treasury note rate of the day and you add this spread, and that tells you the actual interest rate that you're either paying or receiving, depending on whether you're receiving fixed or receiving floating. Now, if you notice, if you keep going down the list, the spread gets bigger. And by the way, why are they doing this? Why don't they just write 2.2% and 2.28%? Because then they have to change it every single day. This way, the spreads themselves will probably not change very often. So they can leave the chart or the quotes like this and let the customer figure out how much it is based on that day's treasury note rate. So otherwise, every day they'd have to recalculate these. And then this way, let's face it, the customers can do that. Now, if you notice, like I said, as you go further down the list, as the maturities increase, so do the spreads. Why is that? Because the longer maturity swaps are riskier. So therefore, the dealer needs additional compensation for getting into a longer maturity swap. Why are they riskier, by the way? Well, 2 reasons. Number one, let me get this all set up. Why are longer maturity swaps riskier than shorter maturity swaps? Number one, they have more credit risk. Number two, the longer the maturity, the more the value of the swap fluctuates when interest rates change. So that's why they're considered to be riskier. More credit risk for the longer term ones. And we also will see that the longer the maturity, the more the value of the swap fluctuates when interest rates change, if they do. So that's why the dealer has to really charge a higher spread on those longer maturity swaps to cover their own risk. They're not in the business to make, they're trying to make money without taking on excessive amounts of risk. All right, so this is a typical quote from a dealer for pricing fixed for floating rate swaps. And again, it's typically not quoted in absolute terms, but spreads to the treasury market. And then as the treasury note rate changes, these numbers can be recalculated very quickly and easily. All right. Now, suppose a U.S. corporation issued $100 million worth of 10-year 6% coupon bonds 5 years ago with annual coupons. Now, this company is pretty certain that rates will drop in the future, and they want to go the other direction. They want to transfer their fixed rate liability for a floating rate liability. So they might call up the same exact dealer and arrange to do the opposite of what the previous corporation did. In other words, they want to trade fixed for floating. All right. So here's an example of how this might work. So they're paying 6. They approach the dealer who says, all right, if you want LIBOR, we'll give you 4%. Now, if you look at it carefully, the dealer is receiving the LIBOR and they're paying the fixed rather. The corporation is receiving 4, they're paying 6. So their cost, their interest cost has risen, or well, I shouldn't say has risen, has changed from what it was originally 6 to LIBOR plus 2. Why is it plus 2? Because they're receiving 4% from the dealer and they are paying 6% to the bondholders. So this way, if they are correct and LIBOR drops, they could save some money. But if they're wrong, they could end up paying even more. And now, of course, the dealer, not wanting to be in this position, may approach another company and say, all right, we want to pay you LIBOR. Let's say this is a bank that has the opposite outlook. They're going to offer to pay LIBOR to the bank in exchange for something slightly higher than 4%. Let's say it's 4.2. Well, that means that they made 0.2% or 20 basis points in the swap. Now, by the way, if you notice, I'm assuming that no defaults take place when I calculate these profits. If there's a default, then anything could happen. If not, then the dealer has locked in 0.2% per year for the next so many years, based on the original notional principal. That's what they're trying to do. But then, yes, occasionally a customer's default and they end up being left holding the bag. But, it's just like any other bank, let's say, that's part of the cost of doing business. Lending out money means sometimes you don't get it back. All right. Comparative advantage. Now, comparative advantage is the case where it may be possible to borrow more advantageously between the fixed and floating rate markets. Okay, so here, instead of issuing a bond, we need to borrow money. The question is, how do we want to finance it? Now, we have to assume in this section that there's some reason why you might have an edge over your competitors in one market, but not the other. All right, so now I don't know exactly when that might happen, but let's assume that that's exactly what is happening. So in the next chart, we're going to see two corporations, ABC and XYZ or XXX, and we're going to see their borrowing costs in the fixed and floating rate markets. So let's say that they are prepared to, I mean, they could borrow this money from a bank or else they can issue bonds. The bottom line, though, is that ABC is more creditworthy. They will pay a lower rate, whether it's the fixed rate market or the floating rate market. But if you notice, ABC's advantage is more pronounced in the fixed rate market. They have an advantage in the floating rate market, but it's not quite as large. So we would say in economics that ABC, and you may have heard of this if you've ever taken an economics class, ABC has an absolute advantage in both markets. Now, in fact, you know what I'm going to do? Let me copy this table so you can see it all at once. All right, here we go, right there. That's good. So ABC has an absolute advantage in both markets, meaning it can borrow more cheaply in both markets. That's true. But their advantage is more pronounced in the fixed rate market. And in economics, we say that ABC has a comparative advantage in the fixed rate market because its advantage is greater than in the floating rate market, 2% versus only 1%. And then, although it sounds wrong, but it turns out that XXX therefore is considered to have the comparative advantage in the floating rate market because its disadvantage is smaller. And so you know what what this means is that, and let me just expand on this a little bit. Both corporations can benefit if they borrow in the market in which they have a comparative advantage and then swap the proceeds with each other. Okay, so we're going to see how that works in a second. In other words, ABC, according to this principle of comparative advantage, ABC should borrow in the fixed rate market and XXX should borrow in the floating rate market, and then they can trade the loans with each other so that ABC now pays LIBOR plus 3 in exchange for 5, and the opposite happens with XXX. All right, you'll see what I mean in a second. Let's put together this example. Now, by the way, we're making an assumption here. If ABC wants to borrow the fixed rate, then none of this makes any sense. Okay? In other words, there's some reason why ABC wants to borrow floating. Suppose they're very, very convinced that rates are heading down and they would like to borrow at the floating rate, LIBOR plus 2. And let's say XXX has the opposite outlook. So they would like to borrow in the fixed rate market. Well, it turns out they can save money if they borrow in each other's, in the opposite of the market that they want to, and trade the cash flows with each other. So how exactly would that work? So ABC will borrow floating at LIBOR plus 2. So let me show you that in this graph. Wait a minute. Oh no, hold on a second. ABC wishes to borrow floating rate. XXX wishes to borrow fixed rate. So ABC would then be required to pay LIBOR plus 2. XXX would be required to pay 7. All right, so in that case, ABC goes into the market. and they borrow whatever they're borrowing, it's going to cost them every year. Let me just get this straight. All right, so let's try that again. ABC is paying LIBOR, I'll call that L, or this is what they wanted to do in the first place. XXX is paying 7. The total that they're paying between the two of them is LIBOR plus 9%. Now, can they do better? Yes. So here's what they're going to do. Let's say they borrow in each other's markets. ABC is, I'll tell you what, why don't we do this? I'm going to go ABC, I'll go to the fixed rate market and borrow at 5. Okay, it's 5. All right. XXX goes to the floating rate market and borrows at LIBOR plus 3. All right. Oops, no, sorry, lender. I did it again. No, this is supposed to say lender. And this is LIBOR plus 3. Now, if you add those up, what do you notice? The total borrowing cost is this time only LIBOR plus 8. So the total amount that the two of them are spending on interest is LIBOR plus 8, 1% less than before. How do they each benefit from this? Well, here's what they can do. Let's say that ABC agrees to pay LIBOR to XYZ, XXX, and in exchange, XXX pays them 3.5%. So what have they accomplished now? Well, ABC's net borrowing costs now are LIBOR plus 1.5%, because remember, they're paying 5% on their fixed rate loan, and their net payments to XXX from the swap are LIBOR minus 3.5%. So their borrowing costs are LIBOR plus 1.5%. But guess what? It would have cost if ABC had borrowed in the floating rate market directly. If you remember from the beginning of this example, they would have been charged LIBOR plus 2%. So they saved 0.5%. Now, XXX, because they borrowed in the floating rate market, in the terms of their swap, they're paying 3.5% in exchange for LIBOR, 6.5%. So if XXX had borrowed in the fixed rate market, it would have paid, or it would have cost 7%. So guess what? We managed to arrange this so that the total savings are 1%, and each of the two companies is saving 0.5%. So they basically split the savings right down the middle by swapping directly with each other. Now, in practice, they probably would not swap directly with each other. They would probably find an investment bank to act as an intermediary. But still, the bottom line is they're arranging the swap between themselves so that they can take advantage of the differential borrowing costs in the two markets. But none of this works unless they have a comparative advantage in different markets. If they both have a comparative advantage in the same market, none of this does either side any good. Okay, so this is just a chart where I just essentially did the exact same thing. So you can see it all lined up, and you can see that both sides managed to save 0.5%. They're very pleased with each other, aren't they? Yes, because they use their cleverness to save borrowing costs. Now, of course, here's the thing they have to watch out for. They're still both exposed to credit risk. If ABC goes out of business, XXX might not make any money. In fact, they might lose money. Same thing with XXX. So yes, it's true that they've found a way to make money or save money, but it's also true they're both now exposed to credit risk. And so that's something that has to be taken into account. But now some people would say that this is not likely to happen in practice because this can only arise when markets are inefficient. But the bottom line is markets are never going to be perfectly efficient. So if an opportunity like this comes along, you've got to take advantage of it. Okay. And don't just say, well, this can't work because, that would mean markets are inefficient. No, here's an example where it works. All right. Now we get to the fun part. How do we price these things? All right, that's a very good question. And that's when we're going to need Excel to help us out. So the price of a fixed for floating rate swap equals the difference between the present values of the cash flows from the fixed rate side and the floating rate side. All right. If the present value is the same for both sides, then the swap is worth 0. And in fact, when the swap is first entered into, the rates will be chosen on purpose to make sure that this is exactly what's happening. The swap should start out with 0 value, and then as time elapses and interest rates change, the price will go up for one side and it will go down by the same amount for the other side. But how do we figure this out? All right, so again, when we first enter into the swap, the price will be 0. The rest of the time, the price probably will be different from 0. Okay. It will have a positive price for one counterparty, a negative price for the other counterparty, but these two must add up to 0. Now, of course, as you can probably guess, if you're the fixed rate payer and the floating rate receiver, then if rates go up, you're happy because you're receiving higher interest payments. If you're the floating rate payer, this is exactly what you do not want to see. And of course, if falling rates work in the opposite direction, they will cause the value of the swap to fall for the fixed rate payer and rise for the floating rate payer. Now, the price of an interest rate swap can be determined in one of two equivalent ways. First, we can treat an interest rate swap as a portfolio consisting of a fixed rate bond and a floating rate bond, which is sometimes known as a floating rate note or FRN. What does that even mean, a floating rate bond, by the way? Well, with a normal bond, let's say you have a fixed rate bond. So let's say that it has a face value of $1,000 and the coupon rate is 5%. And let's just keep it simple. Let's say it's a 3-year bond. So initially, we're here at time t equals 0. Next year, we'll get a $50 interest payment or coupon payment. The following year, we'll get another 50, and then finally, we'll get not only a $50 coupon payment, but we'll get our $1,000 back. Those are the cash flows to a fixed rate bond. If the bond is floating, though, here's how it's going to be different. Let's say we have a floating rate bond. Same face value, but the coupon is LIBOR. And it's still 3 years. So this is very different because what's going to happen now is that this coupon in year 1 is the 1-year LIBOR rate observed at time 0. So I'm going to call this L0. That's meant to indicate the payment based on LIBOR observed at time 0. So if the LIBOR rate was, for example, 6% on that date, then you get a $60 coupon payment here. And then here, it's the same thing. We'll call that L1 to indicate that it is the LIBOR rate observed on date 1, and it is multiplied by the face value. So if LIBOR was 3% on date 1, that means we're getting a $30 coupon. And then finally in year 3, we're getting LIBOR 2 plus our $1,000 back. And so what's interesting about this is that we don't know what the next coupon rate that comes next is determined 1 year in advance. So all throughout this period, we know what the next coupon will be, but only that one. We know L1. We don't know L2 yet. That has to wait until this time t equals 2. Now that has an interesting consequence, by the way. And so in order to fully understand that, we need to do a bit of a detour here. So imagine the following situation. Suppose a bond is issued with a face value of $1,000 and a coupon rate of 5%. The bond will mature in 1 year. If the bond's yield to maturity is 5%, what is the price of the bond? All right, so how does that work? Now, the yield to maturity is the discount rate that applies to the cash flow of a bond. So in this case, the price today let's do a timeline here. Now we know for a fact that we're getting $1,050 in 1 year. That's the last coupon payment and the face value. So the present value, or the price today, is $1,050. In the denominator, we have 1 plus the yield. and we have an exponent equal to the year in which this cash flow is received. Okay, so in other words, in general, we have the cash flows in whatever year it happens to be Okay, so this happens to be a 1-year bond. So what you'll notice when you divide this out is that the price is exactly $1,000. So if I wanted to buy this bond today, I would be expected to pay $1,000 for it. That's listed as a negative number because that's coming out of my pocket. So I'm paying $1,000 now. I'm receiving $1,050 in 1 year, and my price for that is $1,000. Now, what if I changed the yield to something different? The coupon is fixed, but the yield can change. All right, let's see what I can do here. I just want to make 1 or 2 little changes. Let's change this to 4. Oh, okay, there we go. So I just want to make 1 little change. Okay, so 1050 divided by 1.04 is 1,009.62, which is more than, of course, $1,000. So if I want to buy that bond today, it'll set me back $1,009.62. And then let's try the opposite case where the rate goes up. The yield to maturity of the bond is going up. So I only have to make 1 tiny little change. Let me get those changes made. So we have 6. And let's see what happens. $990.57. Okay, so what I'd like to do is summarize this in a nice little table. Let's see. All right, so I have to pick. So we'll have the price. We'll put the yield here and the price. In fact, you know what else we'll do? Yeah, oh, here we go. No. It's being such a pain. God, well, I don't know why it would refuse to work, but all right, so what we're going to do is put together a little chart so you can see this relationship. Let's see. All right, it should be ready now. All right, so here's what we're gonna do. Try to make it too perfect. So when the yield in the initial example was 5%, the coupon rate is 5%, the price of the bond was 1,000. When the yield dropped to 4, the price went up to 1,009.62. And when the yield went up to 6, the price dropped to 990.57. So what we want to take away from this is a couple of key things, and this will help us with the pricing of the interest rate swap. Otherwise, I wouldn't go through this example, but yes, this will definitely help with the pricing. So when the yield is less than the coupon rate, the price is greater than the face value. When the yield equals the coupon rate, the price equals the face value. And then one more, I guess we can fit it here. When the price is greater than the coupon rate, the price, the yield is greater than the coupon rate, the price is less than the face value. Now, this is all very important, but the case that we need for pricing swaps, the floating rate side of the swap is this one. That's the key result that we're really interested in right now. So again, when the yield is above the coupon rate, the price falls below the price of the bond falls below the face value. When the yield and the coupon rate match, the price equals the face value. And finally, when the yield is greater than the coupon rate, then the price must be less than the face value. Well, so the reason why this matters is this. Suppose you had a floating rate bond. 3 years, just like we had before. The coupon here is L0 and L1 and L2 plus 1,000. So let's take a look at L1. So what's happening here is that we know well, actually, all right, no, yeah, that's right here, L1. If the rate, whatever the rate is, let's say this is $1,000 face value bond. Suppose that the rate L1 is 3%. That means the coupon is $30. Okay. Well, actually, no, I'm sorry. This is the wrong one. This is not the one that I wanted. Let's try this one. Let's say L2 is 2%. So the total cash flow will be 1,020. So what that implies is that on this reset date, as it's called, the price of the bond would be $1,020 divided by 1 plus the yield, or in this case, the LIBOR rate, which would be exactly $1,000. Now, the same thing is true at these other dates because, like, for example, at time L1, we know that we're going to get a $30 coupon in 1 year, and we know that the face value of the bond is $1,000. So we can make the case that on this reset date, the price of the bond in the market should be 1,030 over 1.03. And that's also equal to $1,000.
Yeah. Professor, just a clarifying question, if you don't mind. L1, L2, these are the LIBOR rates, right?
That's correct. That's my own notation. L1, L2. L1 means the LIBOR rate that applies on that date, on date 1. L2 is the LIBOR rate that applies on date 2.
So this is the 1-year rate. So
yes, these are 1-year LIBOR rates. That's correct. So in other words, L1 is the 1-year rate, 1-year LIBOR at time t equals 1. L2 is 1-year LIBOR at t equals 2. And of course, that means that L0 must be 1-year LIBOR today. Because today.
So how do you get this L1 and L2 rates? Are they available?
Oh, you should still be able to get them. You could go to the Wall Street Journal. Let's see if we can find it right now. I know that they're getting rid of it, but
okay, gotcha.
They should have them right here. There it is. Yeah, they're still publishing it. So the 1-year LIBOR right now is 0.29238%. Now, they're low, of course, because of what's going on in the world, but those are your LIBOR rates as of today. And, you can get all the one. You notice, like I said, you got a week, a month, 2 months, 3 months, 6 months, and a year. So there's a lot of nice choices here. They also have, they have all of them, don't they? They even have foreign government bonds here. Man, look at that. The UK has such high interest payments. Nice. But yeah, you can easily find these out. And like I said, if you have a Bloomberg terminal, you can just look it up. It'll be right there. All right. Anyway, what is the point of this discussion? What this means is that the value, and this is the bottom line to all of this discussion, the value of a floating rate bond cannot be determined by simply calculating the present value of all the future cash flows, because they are not known today. But we note that on each reset date, the value of the bond is guaranteed to equal the bond's face value. That's what we're trying to get at here. On each of these reset dates, time 0, time 1, times 2, times 3, in each of those 3 dates, the bond is worth exactly $1,000. And so that's how we're going to price it. When we're pricing our swap, the floating rate bond will be considered to be worth exactly $1,000 on each of its reset dates. If we're not at a reset date, we can still use this information. Like, for example, what if I told you that 6 months right here, the LIBOR rate, I'll call it LIBOR 1/2, is 1%. I could actually apply that to this 6-month period, knowing that I'm going to have an asset worth $1,000 in 6 months. So I could price it. Let me just throw this down here. The price of the floating rate bond and so that 1%, I'd have to cut that in half because that's an annual rate. I'd have 1,000 divided by 1 plus half of 1%, divided by 2, because I know that this payment will take place in 6 months rather than 1 year. And so the price of the floating rate bond would be, $995.02. Because I know that it will be worth $1,000 at time 1. Okay, so this is a hugely advantageous way of calculating the price of a floating rate bond, given that we don't actually know what all the future cash flows are. So this is how we work around that little problem. So wherever we are on that timeline, we can still figure out the price of the floating rate bond by simply looking ahead to see where the next reset date is and recognizing that the price will be $1,000 on that date. And so from today's perspective, we need to calculate its present value with the currently observed LIBOR rates. So that means we can do this. Oh, and by the way, this is still approach number 1, where we're trying to treat our swap as a portfolio of a fixed rate bond and a floating rate bond. Now, by the way, let me just show you why that must be the case. Why is it the case that you've got simply a portfolio of 2 bonds? All right, well, let's look at it this way. I'm going to create a timeline. An investor enters into a swap, interest rate swap, based on a notional principal of $1 million. The investor pays 3% in exchange for LIBOR. What are the cash flows to this bond? To this swap. All right, so I'm going to do it in 2 different ways. I'm going to show just the net cash flows, and then I'll show you how we can split it up to replicate the cash flows to 2 different bonds. All right, so I'm going to initially, at time 0, there are no cash flows. The notional principal, as you recall, is not exchanged. So at time 0, there's no cash flows. And now going forward, I'm paying 3%. So we could think of this 3% of $1 million is $30,000, or 3%. Let's think of it as 3%. So the way we'll think about it is that I'm receiving LIBOR, specifically L0, and I'm paying 3%. You know what? I have to be careful with the notation here. Yeah, I'll tell you what I'll do. I'll put the times down here a little further below. Oh, and let's just keep it simple. Let's say it's a 5-year bond or 5-year swap with annual payments. Just keep it simple. Okay, so I collect LIBOR and I pay 3%. This time I'm collecting LIBOR 1, which means remember this number. I'll tell you what, instead of putting 3%, why not just put the $30,000? So that means L1 means the LIBOR rate times $1 million. How about that? Oh, you know what? I'm going to definitely run out of room. Let me start this again. Trying to figure out the optimal way to do this. It's kind of challenging. No cash flows here. Gain of LIBOR 0. You paid 30,000. Man, I still might run out of space. No, I think I've got it made. All right, here 5. I get my principal back. And down here, though, it's minus 30, minus $1 million. Well, actually, no. You know why? I just realized, no, that's not correct, because there's no transfer of the notional principal. So this is just straight ahead, L4. And down here is just minus 30,000. So those are the net cash flows to the swap, because there's no exchange of principal. Now, what I'm going to do is rewrite this slightly in a slightly different way, so you can get the idea what this is all about. So why don't I write it like this? I'll write 2 separate timelines, one for the floating rate bond and one for the fixed rate bond. So here I'm paying $1 million, and then I received all the LIBORs. And here I regain my $1 million plus L5. So these cash flows match up with the person who owns the floating rate bond. I'm paying $1 million, I collect all the coupons, and at the end I get my $1 million back. So this is the equivalent of saying I am the owner of a floating rate bond. Okay, down here I have the fixed rate bond where I am the seller. So here I'll put in parentheses the buyer, and down here I'll put the fixed rate bond, I am the seller, which means I collect $1 million initially, and then I pay 30,000. And then at the end I pay $1,030,000. Or I'll tell you what, I'll leave it like this, minus the 30, a million, minus 30. Now, in the bottom, you can clearly see this is the position I would be in if I were the fixed rate bond seller. Now, what I would like to also have you notice is that if you look at the cash flows on the top and the bottom, some of them cancel each other out. In particular, these cancel each other out, and these cancel each other out. So if you look at the net cash flows that remain behind, let's see, the net cash flows, I guess I could draw it in purple, it doesn't matter. This is just exactly what we had before. In other words, up here we have plus L1, plus L2, plus L3, plus L4, plus L5, minus 30. And this is exactly what we mean by a fixed for floating rate swap, where we are the fixed rate payer and the floating rate receiver. Us and them. All right, no, it's our corporation and the dealer. So this set of cash flows is just the same as what we have here. So this is our fixed for floating rate swap. So us, the corporation, I'll call it, and this will be the dealer. The corporation is paying fixed, receives floating, and it is the equivalent to, if you look at this graph, being the buyer of the floating rate bond and selling the fixed rate bond. So from my perspective, the corporation who's entered into a swap to pay fixed and receive floating, it would be the same exact thing as if I had bought a floating rate bond with a LIBOR coupon and sold a fixed rate bond with a 3% coupon. So therefore, the value of the swap must equal the value of this portfolio. And why is that? Because, well, you know why, arbitrage. Okay, so since the cash flows to the swap equal the cash flows to buying a floating rate bond and selling a fixed rate bond are identical, in order to avoid an arbitrage, the price of the bonds must equal, or I should say the total or net, probably we should think of this as the net price of the bonds, because one is positive and one is negative. The net price of the bonds must equal the price of the swap. Otherwise, like I said, there'd be an arbitrage opportunity, which we know very well what our arbitrage means. And so therefore, when I price the swap, I'm not really pricing the swap, at least not with this approach. I'm pricing the two bonds. And so one will be positive, one will be negative. The difference between the two will be the price of the bond to the corporation who is in the swap, paying fixed, receiving floating. The price to the dealer is just the negative of the price to the corporation. So we really only have to calculate this once. So why don't we look in our spreadsheet and see how this works? Let's see, did I mention that? Yes, here it is. And then by the way, the second approach, we'll have to discuss this separately because we haven't really talked about forward rate agreements yet. So instead, we'll just dive right into this example where it says, suppose that 6 months ago, a 4-year fixed for floating rate swap was entered into with a notional principal of $100 million. The floating rate is 1-year LIBOR and the swap rate is 5%. Payments are exchanged annually. Okay, well, how do we price this thing? Well, we need to know the LIBOR rates. But first, let's note that the fixed rate payer, which is what we had in this example, the corporation is a fixed rate payer, has the same position as if they had bought a floating rate bond, a $100 million floating rate bond with a coupon of LIBOR, and paying for this by selling a $100 million fixed rate bond whose fixed annual coupon is 5%. Oh, and by the way, I mean, it should be understood that both of them must have the same maturity. Otherwise, we're comparing apples and oranges. And then the floating rate pair is just the opposite. So we're going to go into Excel and say, well, all right, well, this is a $100 million bond. The coupon is 5 in this example. Okay, once the bond the bond itself, the coupon rate never changes. And so, oh, and by the way, yeah, I guess we should mention that too. The fictional bond that you are buying and selling, the fixed rate bond, I just want to mention that. The coupon of this fictional bond is the fixed rate in the swap. So in other words, in this example, it was 3%. Remember, the fictional fixed rate bond is a 3% bond. Okay, so the coupon in that bond is the fixed rate in the swap. All right, now, so here in this case, the swap itself is based on 5%. So that's our coupon. The annual coupon to this bond, the fixed rate bond, is $5 million. On the floating rate side, it's LIBOR, but we're going to claim that at the moment, the LIBOR rate is 3.5%. Okay, we're going to assume that we know that. Now, I just want to mention here that the way this thing has been structured, this is a 4-year swap, but it was entered into 6 months ago. So there's still 4 cash flows to go. But look at the times, they're very unusual. The next cash flow, the next coupon payment occurs in 6 months. The next one after that is 1.5 years. Then we have 2.5 years and 3.5 years. So the coupons on those dates are $5 million. And finally, at the end, we have $105 million because we're getting our money back. All right, now, the floating rate note, though, on the other hand, now the next reset date takes place in 6 months. Right now, the LIBOR rate is 3.5%. So because the next reset date takes place in 6 months, we know that it will be worth 2 things. The coupon payment, which we've already observed to be 3.5%, and the notional or face value. So we know for a fact that in 6 months, the floating rate side will be worth $103,500,000. That's all we need to know, by the way, because we don't know what the rest of the cash flows will look like. Now, the discount factor, remember, these are present values, but there's a twist here. And this is not that unusual with derivatives markets. We're assuming continuous compounding with these rates of interest. This is not necessarily always done this way, but some authors like to use continuously compounded rates of interest. So just a quick reminder, I'll throw it in right here, I guess. With continuously compounded rates, the present value equals, okay, so you take your principal, whatever it is, and you multiply it by E. Let's get rid of that purple. E to the minus RT power. This is the principal. This is the rate. And this is the time. Okay, so just a quick reminder, when we're assuming continuously compounded interest rates, which, like I said, is frequently done with the derivatives markets, although not always. It depends on the author of the book that you're using. Like in our case, we're using Hull, and Hull loves continuously compounded rates of interest. It's probably because they have superior mathematical properties that we'd like to take advantage of. So therefore, these discount factors represent the present value of $1 received this far in the future. And if you look at the formula, you'll see it's equal to E raised to the exponent. E is raised to the power minus, oh, here it is. Oh, you know what this is? This is the chart of the LIBOR rates that apply to each of these time frames. So if you look in the Wall Street Journal right now, the 6-month LIBOR rate, by the way, here's a stretch that they're making for us here. LIBOR only goes out 1 year. They're assuming that there's a way to derive these from other types of securities. If that weren't true, we could never price any swaps that had a maturity more than a year. So that we'll kind of have to gloss over and assume that this is possible. But let's just say that we have all these LIBOR rates. So this number is equal to E, and the exponent is the LIBOR rate times this time period until that cash flow is received. So in other words, if I wanted to have $1 in the bank in 6 months, I'd have to set aside 98.02 cents when the bank is paying 4% compounded continuously. This is important because all these cash flows have to be discounted back to the present. So what I'm going to do is multiply these discount factors by each of these cash flows from the fixed rate bond and add them up. This right here is the price of the fixed rate bond. I only have to do this once with a floating rate bond because we're assuming that we know the price in 6 months to be $103,500,000. So I'm going to discount that one. And as a result, that present value is $101,450,562.69. Now, here we go. The difference between these two is the price of the swap. So if you're the fixed rate payer, you own the floating rate bond, which is worth a little bit more than the fixed rate bond. Your swap value is $849,542.79. Of course, if you're the floating rate payer, then it's just the opposite. This is the negative of this. And I double check that by adding them up to come up with 0. Now, what this means, now, normally these are contracts between the two sides. You don't normally go off and sell the swap to somebody else. Okay, it's not because you've made an arrangement with a counterparty. But if for some reason you are the fixed rate payer and you want to terminate the swap because you decided that you no longer need the protection, then the floating rate payer in principle should pay you $849,542.79 for the right to offset the swap. So now, of course, in a case like this, it's not necessary to agree to do this. Both sides have to agree in order to terminate the swap, but this is what it would cost to do it. So that's really the significance of this value. It's not like it's a stock where I can turn around and sell it for $849,542.79. Instead, it means that if I were to try to offset the swap or unwind it, the floating rate payer would owe the fixed rate payer that difference, which is $849,542.79. All right, so I think this example is the easiest way to understand what we're doing. Ultimately, we're taking the price of the fixed rate bond and comparing it to the price of the floating rate bond. And the difference works in the favor of one side or the other. The fixed rate payer, it's equivalent to owning the floating rate bond and having sold the fixed rate bond. Therefore, they're ahead. The floating rate payer must be the opposite. Whoa, that was complicated. Now, unfortunately, the next one is maybe even a little bit, maybe not. It depends. Oh, these are the foreign exchange swaps. Okay, these are a little bit trickier, but anyway, so I just want to mention in passing that an alternative approach is to treat our swap as a portfolio of what are called forward rate agreements. I'll just briefly mention a forward rate agreement. Here it is. And we'll get into this later on in another chapter, not right now, but a floating rate or forward rate agreement is a forward contract where the underlying variable is a rate of interest. Okay, an FRA can be used to lock in a lending rate or a borrowing rate. So we could look at each we could consider each exchange of payments in an interest rate swap as the payoff to a forward rate agreement, and then add up the values of these FRAs to come up with the price of the swap. Okay, so we're not going to do that as a separate example. We don't have all night here. And we may revisit this when we go on and actually introduce forward rate agreements properly. But what we'd like to do instead here is jump ahead and look at how to price a currency swap. Now, with the currency swap, we're actually going to do both of the alternative approaches because one of them we already know very well. So in other words, what are the two approaches to pricing a currency swap? Let's see. Well, all right. Well, we'll get to that. Don't worry. But there's two alternative ways of doing this. And one of them involves forward contracts. And of course, we already know how those work. So we're definitely going to look into that. But it also can be thought of as an exchange of two different bonds, just like the interest rate swap. So we're going to look at both approaches. And By the time we're done with that, I guess we'll be out of time, but we'll be very good at pricing both interest rate and currency swaps. And then I think at the end, there's a quick discussion about alternatives types of swaps that do trade in the market. All right, so it's getting pretty late. Why don't we have our break right here? And then when we get back, we'll go through and remind ourselves what a currency swap looks like. And then what we'll do is price them. Okay. So let me save this real fast. All right, so let's have our break. And when we get back, we'll dive deeply into the pricing of currency swaps. Hmm. All right, we're back. So of course, with a currency swap, we're trading cash flows based on two different currencies. Typically, both interest rates, though, are fixed. It's not that they can't be floating, but it's not normally the case. The standard currency swap involves the trade of cash flows, two fixed rates, but two different currencies. And also, unlike an interest rate swap, with a currency swap, there is an actual exchange of principal at the beginning and the end of the swap. All right, so that makes it a little more challenging to price them. So how does this work? A U.S. corporation wants to invest in a 5-year, 100,000 pound bond with a 6% coupon rate that's issued by a UK corporation. But we do not want to expose ourselves to any foreign exchange risk, of course. So that, of course, if for example, the dollar were to appreciate while we were holding this bond, the dollar value of our coupon payments and principal would actually be reduced. So by buying this bond, 6% times 100,000 pounds is 6,000 pounds. Let's just say that at the moment, the exchange rate is $1.90 a pound, which means that the coupon payment would therefore be worth $1.90 per pound times 6,000 pounds, or $11,400 per year. Now, there's the rub, though. There's no guarantee that this will stay the same throughout the lifetime of the swap. So what do we do about it? And and by the way, this is what I said before. If the dollar were to strengthen to $1.80 a pound, then this coupon payment would only be worth $10,800 US. So that's what we worry about when we enter into one of these agreements. So what can we do? Well, because we're worried about this dollar getting too strong, what we can do is offset these risks by entering into a currency swap where we're paying a fixed rate of interest based on pounds and receiving a fixed rate based on dollars. Now, of course, this is more convenient for us as an American company because we're eliminating any risk involving the pound and we're locking in a specific rate of interest denominated in dollars. And that's, of course, the whole point of all of this. Now, here we go. So the corporation agrees to pay a fixed rate of 6% in pounds to a swap dealer. In exchange, we will receive a 5% fixed rate in terms of dollars. And once again, let's assume that the spot exchange rate is $1.90 a pound. Now, this is the part that's different. We do have to actually go through the formality of using dollars to buy this bond. So we'll exchange 190,000 US dollars for 100,000 pounds, and then we buy the bond. And these are the notional principles that we'll use throughout the lifetime of the swap. Now, the trade that we agreed to is the corporation is paying 6% to the dealer denominated in pounds, and in exchange receives 5% in dollars, which is worth $9,500. Okay, so in other words, the principal of this bond that we're buying is both 100,000 pounds and $190,000 because the current exchange rate is $1.90. So that determines the size of the coupon payments, 6,000 pounds, which we pay to the dealer, and $9,500 comes back from the dealer. At the end, initially, we do have to pay $190,000 for 100,000 pounds. At the end, those cash flows will be reversed. All right. So this is what it's supposed to look like. Now, the only thing that's really missing from this diagram is the initial exchange of, and the principles are not shown on here, the notionals, but the intermediate cash flows are. And you can see that by entering into the swap, the corporation owns a UK bond, which pays them 6% in pounds, which we're now trading off to the swap dealer in exchange for 5% in dollars. The notional principles will be the same at either end of the swap. 190,000 US dollars is traded for 100,000 British pounds in the beginning and at the end. Okay, so they basically offset each other. So what we're doing is replacing a 6,000 pound coupon every year with a $9,500 coupon in terms of dollars. All right, now let's price that thing. Let's come over here and price it. So we started out with $1.90 a pound is the current spot exchange rate. And what we're basically saying here is that, let's see. The US firm is paying $190,000 to buy this UK bond. All right, let me sneak this in here. The US corporation initially pays $190,000 for 100,000 pounds to buy the bond. Okay, now at maturity, the corporation will sell the 100,000 pounds and let's see. Let me go back here for a second to make sure that we have this all in here. Okay, for $190,000. That's the agreement that we've entered into. So in effect, the swap there it is. There it is. Okay, I wasn't sure. Okay. So I'll just, it's down here. The U.S. corporation has agreed to pay pounds for dollars. The U.S. corporation has the same position as if they bought a dollar bond and they financed it by selling a pound bond. And so the difference between these two represents the value of the swap to the U.S. corporation. The dealer has the opposite position. And so they are in the equivalent position of owning the pound bond and being short the dollar bond. And so therefore the value of the swap is just the opposite. In other words, it's negative instead of positive. But how did we come up with the prices of these two bonds in the first place? Well, let's see. So for the US bond, we have $9,500 in coupon payments every year. In the last year, we received the face value of $100,000 plus another, $190,000 plus one final coupon payment. Now we're calculating present values, and again, we're actually using continuously compounded rates. So I'll just add that to the top. And so we have in this column, this would be the principal times e to the minus the rate is way over here somewhere for some reason. I put them, I've got way over here. The US rate is 3%. We're assuming that the US rate is 3% in the beginning of this swap, and the UK rate is 5%. So that means I'm discounting these, here it is, it's 3%. This is discounted for 1 year, 2 years, 3 years, 4 years, and 5 years. So the formula here will be e to the minus the US rate times the time multiplied by the principal, which is right here, $9,500. So using that US rate, which is fixed at 3% for 5 years, that's an assumption, by the way. It doesn't have to work that way. A lot of Hull's examples, he likes to have the same rate for several years in a row. So we're assuming that to keep things extremely simple, the US rate of interest will stay at 3% for the foreseeable future. So all these cash flows are discounted at the US rate of 3%, but we're using continuously compounded rates. And so these are the numbers we came up with. So right now, the market price of this bond is 206,985.33. The equivalent or the corresponding British bond has coupons of £6,000 per year. At the end, we get our principal back of £100,000 plus one final coupon payment. And here we're discounting all these cash flows with continuously compounded rates, but this time the rate itself is 5 instead of 3%. So we add these up and we get a pound price for this bond, but we have to convert this into dollars by using the spot exchange rate of $1.90 a pound. So what we're saying is that the dollar bond is worth 206,985.33. The pound bond is only worth 197,155.24. So the corporation that's entered into the swap has a long position in the dollar bond and a short position in the pound bonds, which means that they're up $9,830.09. The dealer is just the opposite. We don't have to do anything else. We just reverse these first two, and you can see that for them, the value is negative 9830.09. So by treating this currency swap as the exchange of a domestic bond for a foreign bond, we've come up with the correct price of 9830.09. All right, so ultimately this table is what we really were after. Okay, we got two bonds, a US bond with a principal of 190,000, which it says up here, and a coupon of 5%, which gives us an annual coupon of 9,500. Oh yeah, there it is, 5%. So there's a $9,500 coupon. And the British bond has annual cash flows of £6,000 from over here, which are currently worth 11,400, and the principal of the bond is 1,000. So therefore, or 100,000. These are the correct cash flows for the UK bond. And then all we really have to do is discount them each by the corresponding rate of interest, add them up, and the only trick is here we have to convert this back into dollars using the current spot exchange rate so that we can compare them directly, and the difference between the two determines the value of the swap. The only question is who's got the positive amount and who's got the negative amount. All right, so this is how we price a currency swap by treating the swap as if it were a trade of a domestic bond for a foreign bond or vice versa. What other options do we have? Well, okay, so there's details in here as well. If the slides have some more explanation here. The spreadsheet is fine, but the slides actually explain what's going on here. And it mentions here, which I forgot to mention earlier, we're assuming that the US yield curve is flat at 3% continuously compounded. Flat means it's the same for every maturity, 3%. So that's why these calculations were unusually simple. So if they're all different, we can use each individual interest rate and apply it to these cash flows. But here we kept it simple by assuming 3% per year, every year for 5 years. UK yield curve is also considered to be flat, which means that the rate is the same for every year for 5 years. Okay. And so we went ahead and did all the calculations. And here I've got the chart set up again. And so again, as we've already seen in the spreadsheet, the swap value to the corporation is 9830.09. And for the swap dealer, it is negative 9830.09. Now, what about forward contracts? We can also price this swap as if it were a series of forward contracts. How would that work? Well, this one I think is a little bit trickier. We've got the same information. Everything's the same, but now we want to price the two bonds. Well, actually, we're pricing the two swaps by pretending that we actually have entered into 5 consecutive 1-year forward contracts to trade dollars for pounds. I put this here to remind us how the forward exchange rate is related to the spot exchange rate when we're using continuously compounded rates of interest. And remember too, R is the domestic rate and R star is the foreign rate. Okay, so of course that means R is the dollar rate and R star is the foreign rate. So these are the actual cash flows. So I'm going to apply this formula to each of these 5 years. The only thing that's different from 1 year to the next is T. Okay, you see T there in the exponent. So for example, this is the spot exchange rate of $1.90 multiplied by E raised to the 3% minus 5% times 1, because this is 1 year in the future. Then for the next year, we replace T with 2. And so naturally enough, the number goes down. Then we have 3, 4, and 5. This is telling me that if I wanted to enter into a contract 4 years from now to buy pounds for delivery 1 year later. Well, actually, no, sorry. This is no, I had it right the first time. This is what it would cost for me to take delivery. If I entered into this contract in year 4, I would have to pay $171.92 1 year later to buy my British pounds. That's right. Okay, these are all 1 year forward contracts starting at different points in time. Okay, now the dollar cash flow, this number is obtained a little differently. What I'm doing is I'm using the pound cash flows and I'm converting them into dollars using not the current spot exchange rate, but the implied forward exchange rates at each point in time. So this is the product of multiplying these two numbers together. So these are my cash flows in dollars from the pound bond. And the net cash flow is, of course, the difference between the dollar bond and the pound bond. Because nothing's changed, as the US corporation, I still have a long position in the dollar bond and a short position in the pound bond. So the value of my position is the cash flows from the dollar bond minus the cash flows from the pound bond. Now you can see the first 4 are negative, but then I've got a gigantic positive cash flow down here. This is the sum. This number doesn't really tell me a whole lot. This is what I'm looking for at the end. I am now going to use the US rate. Yes, the US rate to discount these cash flows back to the present. And when I add them up, you'll see that, oh yeah, it's the same as we had back here. It has to be, because they're calculated, well, they're calculated in 2 different ways, but they represent the same information. So any way you slice it, the swap is worth 9830.09 to the US corporation, and it is worth negative 9830.09 to the dealer. So here I've priced all these future exchanges of cash flows using the forward exchange rate as if these were 5 consecutive forward contracts. And that's how I determine the net value of my swap. Back here, I'm just looking at 2 traditional coupon-bearing bonds denominated in the 2 currencies. But here, I'm using the forward exchange rate to price the cash flows from the pound bond, and then I can compare them directly to the dollar bonds cash flows and figure out the difference and the present value of those differences. So that's what this is all about. So it's a very complicated procedure. It's not something you can pick it up very quickly or overnight. It takes a while to get used to what's happening here, but once you see the basic logic, it's really not that difficult to figure out what's going on here. So, the assignment that I gave you is just based on this template. So you shouldn't have any trouble filling it in and coming up with the right numbers, but you should pay attention to where these cash flows are coming from. And especially in the cells that have a formula in them, try to figure out where that's coming from. So this, for example, is the formula that goes with these numbers. These are given to us in the problem. This is simply the product of columns C and D. Notice I'm simply converting the pound cash flows into dollars. And then the net cash flows are just the difference between the two, just like we had before. Because remember, the US corporation is long the dollar bond and short the pound bond. And then, of course, you must never forget that you ultimately need to calculate present values rather than the actual cash flows, because that is what's relevant, the present value of those future cash flows. All right.
So,
Yes.
just have a question if you're done. How do you get the forward exchange rates?
Oh, right here, this formula right here.
Okay, gotcha.
Yeah, the spot rate is $1.90. The domestic and foreign rates are 3% and 5%. At each of these rows, that T is coming from here. That's the only thing that changes as I move down the list. Okay. And
yeah,
so,
but yeah, sorry.
Right, go ahead.
So I thought like in this case, the US rate is always 3% and the UK rate is always 5%.
It is.
But this can vary, right? So how does usually in practically, like in real world?
Oh, it would never be 3% every year or 5%. They would be different from each other. But then you would just plug in for each year, you would have a different rate for both countries. And then you would just plug them in for R and R star. Okay, so this is an artificially simple example, but yeah, I mean, you could just look at the yield curve today and you'd see that, let's say maybe the US rate next year is 4% and then 5%. So you would just have a separate column here to keep track of those two rates. And then you could plug them in over here for R and R star.
Gotcha, thank you.
Yeah, it wouldn't be that difficult. All right, now what else do we need to go over? So I did mention that there are other, and by the way, here's the results in the slides. There's more details here if you want to read through here and see what we did, but it's exactly the same as what we did in Excel. The Excel is nice because you can actually read the formulas. You can't really do that here, but you can see there's other types of swaps in the marketplace, and it's interesting to see how they're structured and try to visualize why you might want to use them. For example, I mean, if you want to hedge the risks coming from equities or commodities, you name it, there's a swap out there somewhere that you could use. So, for example, equity swaps, typically what you're trading is the return to a stock for a floating rate of interest. If you're pessimistic about the stock's returns, you can enter into a swap in which you agree to pay the returns to your stock in exchange for a floating rate of interest. Now you can imagine this is a very, very risky situation to be in. But if you're convinced that you're right, well, you might make a lot of money this way. You're essentially gambling that the return of the stock will be lower than the floating rate of interest. Or you're gambling that it could be either one. So you're just comparing the return to your swap, your stock, which means capital gains plus dividends in exchange for a floating rate of interest, which is probably LIBOR. So suppose, for example, a pension fund owns $1 million worth of IBM stock. Now, pension funds, when they buy stocks, they typically try to buy the safest ones. They do not typically constantly trade them. They typically buy assets that they plan on holding for a very long time. But they're worried that IBM is about to have a rough patch. They don't want to sell the stock, but they don't want to risk losing any money either. So what they can do is enter into an equity swap, in which they trade away the returns to IBM, and they receive LIBOR in exchange for that. They can pick any notional principal they want. It depends on how much they're worried about losing. And so at the end of the year, every year, during the lifetime of the swap, they will receive the difference between the two. And if they're right and IBM is having a rough time, they should get positive inflows. In other words, they'll receive LIBOR, pay the return to the IBM, and hopefully the difference is positive. Now, if the return drops, they'll make money from the swap, which helps offset the losses. But if IBM returns go up, they will have to pay back to the dealer the difference between these two. So it could, they may end up deciding this maybe wasn't such a good idea, but what they were able to do is reduce the risk that IBM returns will drop in exchange for sacrificing the upside potential from continuing to hold the IBM stock. And remember, these guys are not going to sell this stock. Otherwise, none of this would be necessary. They would just sell it before the price goes down. But instead, since they're committed to holding the stock, they've decided to at least temporarily hedge the risk that the price of the stock will drop in the near future. Now, commodity swaps, a commodity, by the way.
I have a question, if you don't mind.
Yeah, go ahead.
Would there ever be a situation where you would intentionally buy a stock knowing that you would want to go into an equity swap with it? Or is it only in the case where you have something that you no longer think is going to do well?
That's a good question. I mean, if you really think you know what's going to happen with a stock, let's say that you are very pessimistic about IBM. And you say, listen, I'm pretty confident they're going to have a rough time, but I don't already own the stock. What I could do is I could buy the stock and then enter into a swap like this. And so, like you said, deliberately, I'm buying a stock that I think is going down. And I'm essentially placing a bet by doing this that the stock price will go down. And if I'm right, I'll make a lot of money because I'll be getting LIBOR and paying out the very low rate of return to the IBM stock. So yes, I can see that happening. It would be a way of speculating that the price of the stock is heading down. But I also think there are probably more direct ways of doing that you probably wouldn't go with a swap. You'd probably use an option. Like you could buy a put option on the IBM stock if you're really determined to bet on it, the price going down. I think that would be more straightforward than entering into a swap like this, but it could be done. Absolutely.
That makes sense. Thank you.
Okay. Now commodity. No, commodities are standard items. These are products that are standardized. We do not consume them directly. They're normally used in the input of consumer goods and services. There's a lot of different commodities you could possibly encounter. Commodities include all kinds of metals like gold and silver. You could have industrial metals like zinc and nickel. You could have agricultural commodities like coffee, sugar, wheat, that kind of thing. It can include oil, crude oil, for example. And so basically what they all have in common is that these are standardized products that are not directly consumed typically by consumers, but they normally are inputs into the production process. Although I see nickel, no, people don't buy nickel, but coffee and sugar maybe. But even then, they might be used as inputs into the process of producing something else. But the key detail is that their properties are standardized. So that means if I buy gold in the United States, it's the same as the gold that I buy in South Africa. So the commodities here, of course, the prices can rise and fall. And if you're in the business of producing products from these commodities, one thing that would worry you on a regular basis is if the cost of these commodities might go up and eat into your profits. So if I'm, let's say, a jewelry manufacturer, I do not want to see the price of gold go up. So what do I do about it if I'm worried that the price of gold might go up and thereby reduce my profits? Well, here's what I can do. I can enter into what's called a fixed for floating commodity swap. except the floating rate is not LIBOR, it's a commodity index. So there do exist commodity indexes. The most famous one is the Commodity Research Bureau Index, which is a number that reflects the prices of a wide variety of commodities like metals, textiles, foodstuffs, et cetera, et cetera. And so this type of swap means you're trading the return on that index for a fixed rate of interest. Okay, so it's very much like the equity swap, except that instead of return to a stock, you're looking at the returns to the CRB index. So in fact, why don't we take a quick peek at it just to get a little more background. All right, there it is. The Commodities Research Bureau Index acts as a representative indicator of today's global commodity markets. It measures the price direction of various commodity sectors. It is designed to isolate and reveal the directional movement of prices in overall commodities trades. So it doesn't say here what's in it. I guess we could look at their website and find out. I was just curious to see what's actually in that index. Oh, here we go. So it looks like they've got more than one index, but there is one standard CRB index, which maybe this is it. It says here the commodity BLS price index measures price movements of 22 basic commodities whose markets are among the first to be influenced by changes in economic conditions. And then there are sub-indices for 6 major asset classes. So you've got the overall index, and then you have sub-indices like metals, textiles, industrials, foodstuffs, fats and oils, and livestock. And so I guess presumably it's the number on top that is underlying the standard commodity swap. Okay, the Bureau, yeah, that it looks to me like that would be the standard index. So you're basically hedging or even gambling on the future direction of this index, which comes from these sub-indexes. I'm sure, given that swaps are completely flexible, you could enter into a swap based on one of these sub-indexes just as easily as the overall index. It's just a question of finding a counterparty. Okay, so if you want to speculate on the future of the metals index, you can certainly do so with one of these commodity swaps, but just keep in mind, you're trading the returns for a fixed rate of interest. Right, because the commodity index takes the place of the floating rate. So that means you're trading it for a fixed rate or vice versa. Now, here's a couple of interesting ones. A forward swap is a forward contract on a swap. It means you have an obligation to enter into a swap where the terms and conditions are determined in advance, including the maturity of the swap, the asset underlying it, and the time at which it would start. Now, there's two of these. There's a long forward swap, which specifically means that you are going to enter into a fixed for floating rate swap where you are the fixed rate payer. And the fixed rate is what we call the swap rate. That's the number that's entered into the contract. So when you enter into this contract, you're not entering into a swap right now. You're saying, I want to enter into this swap in 6 months, let's say, where I will pay a swap rate of 5%. And of course, typically the other side would be LIBOR. So this way, the advantage of this is that I can change my mind. In other words, well, actually, no, I can't really. Unless the other side allows me to get out of it. You know, the thing about forward contracts is that you have a legally binding contract in your hands, but if the other side is agreeable, you can always agree to walk away from the whole thing. It's not as easy as we've seen as getting out of a futures position, but still it could theoretically be done. Normally, when you enter into a forward contract, you really want to acquire the underlying asset. But things change, circumstances change, but this is what you're agreeing to do. And then, of course, the opposite would be called a short forward swap, where you're doing the opposite. In this case, you're agreeing to enter into an interest rate swap as the floating rate pair instead of the fixed rate pair. Okay. So now I'm sure there are others. I just only picked a handful of them. The thing about swaps, though, is because they're over-the-counter products, there probably are many strange ones that we've never even heard of. Let's see if we can come up with a list. Here we go. We got others like credit default. Oh, this is a different situation altogether. With a credit default swap, you're essentially buying protection on a corporate bond in your portfolio. You are basically paying some kind of a fee to the other side. And if your bond defaults, then they have to compensate you for it. Total return swaps is very similar to what we've been seeing. It's just you're trading the return on some asset or other in exchange for a fixed rate of interest. So we pretty much covered all the important ones. We usually don't cover this one in a class like this because it's really more of a credit product. Here we're mainly focusing on market risk derivatives, but there are many credit derivatives as well, but it's a very specialized area. So that usually is treated in a separate class. But they're out there, they do exist. So anyway, wow, I think that we pretty much covered everything we wanted to tonight. Just remember, you do have a copy of the swaps template. And so, when you're working on the problem set, that should make things a lot easier. So now tonight, of course, I'll send you everything we did. And of course, next week's notes. And next week, again, I just looked ahead a little bit before, we're going to get back to options. Okay, options are by far the most interesting of all the derivatives. And now for the first time, we'll get a look at some strategies. Strategies are very interesting with options because they're so powerful and flexible. You can create an unbelievable array of different strategies with options that would not be possible with any other type of securities in the marketplace. So that's one of the reasons why they're so popular. The ability to create hedges is like something you won't find anywhere else. Anyway, so I guess if nobody has any last minute questions, we'll knock it off right here. And I'll see you all next time.
Thank you.
Have a
Okay.
good night.
Thank you so much, Professor.
Okay.
Thank you.
All right. Bye.